Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us here again at AusBiz. Well, let's get across what we're seeing on the markets, and we're just managing to hang on in positive territory. Mind you, at the point of this recording, we are at least half an hour, some 45 minutes in fact, off the close. So in danger perhaps of falling into the red. But if we do hang on in the green, it will be 5 successive days of gains on the ASX 200. Let's get across the themes of the day. A weekly win. Well, we're hoping we're going to take that if we do emerge in the green at the end of trade today. Travel trouble. Certainly that is relating to a couple of travel stocks, in particular corporate travel. It's got rid of its UK chief executive, but the stock remaining in a trading halt since August. And cut versus caution. This is the dilemma for many central banks at the moment, most notably locally, given some stronger than expected inflation data, that monthly read we got midweek, but also as we head towards the next Fed meeting, a lot of anticipation about what the Fed members are likely to do, with markets pricing in the likelihood of a 25 basis point cut. Let's get to the sectors of the day, those that have been moving. Tech has, I was going to say it's done well, but actually that's looking a little mixed now. Wisetech, though, is certainly the pick of the bunch, up around 5.5%, but Xero and XTC having come off. Elsewhere, we were talking about travel stocks there in focus. As you can see, obviously corporate travel remaining suspended, but web travel having a good day, along with Flight Centre, which has bounced back well today as well. Among the larger caps, the banks are in the red today, aside from Macquarie, which is managing just to sneak into the green. Let's get into some of the stories making news and potentially moving the markets. And Westpac has received a record New Zealand fine of $3.6 million. Corporate travel management has stood down its UK chief executive after significant revenue issues in its UK business. Star Entertainment rising as it has allowed recently issued shares to Bally's to trade freely on the market. And the Victorian Department of Health has imposed conditions on Monash IVF's clinics in the state. Clearview Technologies gains on South Africa project win. BlueScope has risen. Jeffrey's saying new furnaces may not add value but will cut costs. NRW Holdings has hit a record high after Citi has boosted its price target. And down at EDI gaining as UBS lifts the price target on eyeing growth upsides for the company. Tyro Payments also on the up as Morningstar flagging steady growth despite fierce competition. Well, it is a Friday. It's time to wrap up the week with Shane Oliver from AMP. Shane, welcome to Friday. Good to have you on the show again. Let's start with what we're seeing in the share markets globally at the moment. Since mid-October, certainly there has been some selling pressure going on. Dominant themes there being AI and perhaps stretched valuations, but also what the central banks are likely to do. We've seen a bit of an uptick this week, certainly locally. What are the fundamentals you're looking at, perhaps, that are dragging the share market either way?
I think there is a bunch of things. The outlook for the Fed is a big one. We were seeing various Fed speakers come out on the hawkish side. They now seem to have gone a little bit quiet, maybe to give room for Powell. And in the meantime, we've seen some more dovish commentary out of the Fed from people like New York Fed President Williams. And so that's led to this renewed optimism that the Fed will cut in December. It had gone from about a 40% probability a week and a half ago. Now it's pushing around 80% probability. And we've also seen some weaker data for consumer spending in the US and consumer confidence. So it looks like we probably will get a cut in December, although there's still a way to go yet on that one. So if you put that together with, I think the market sort of coming round to the view, well, maybe the AI story has further to go. It is still pretty positive. That in turn, I think, is also helping, even though there's still these valuation concerns. And it's interesting to note that the US share market has got to within, I think, about 1.1% of its record high. So it's clawed back a lot of that fall. We are coming into a seasonally stronger period of the year. As you can see in that chart there, you often get the seasonal influence is weak through August, September into October, gets a bit mixed, then it turns more positive. The so-called Santa rally kicks in. So, we may be coming into a stronger patch for markets. At the same time, profit growth in the US is still pretty strong. And you get these rate cuts. So all of those things are reasonably positive. And of course, the US share market, despite what's happening here, tends to drag our market with it. It's up just over 3% this week. We're up about 2.3% thereabouts, depending on where we finish today. So we've been dragged up, but not as much as the US market. And that partly reflects the different interest rate outlook in Australia, which has turned more negative relative to that in the US, which seems to have turned more positive.
We'll get to that in just a moment. Shane, you mentioned rate cuts. Look, that's the prospect, certainly as far as the Fed. So interest rates in the States likely to fall. However, locally, the fly in the ointment is very much inflation at the moment. Now, we did get that the first comprehensive monthly read on inflation this week. What did you make of it? I did note that you guys there at AMP were a little cautious about how you can compare this with previous months because this is the first one in the series as such.
Yeah, you have to be pretty careful on these numbers because it is the first full coverage monthly. Well, mind you, it's 87% coverage, but it used to be something like 60, 70% coverage. So first full monthly, we've only got a few months worth of data. So it's the yellowy gold line in the chart there. A bit hard to compare it. Quite clearly, that chart there relates to the trim mean, the underlying measure. And it's a little bit higher than we were previously told, particularly relative to the green line, which was the old monthly trimmed CPI indicator, but also relative to the red line. It was showing higher underlying inflation through particularly the June quarter and some degree the September quarter. So that's a bit of a surprise to us, and therefore I think you do have to be a little bit cautious in interpreting this. I mean, I've been a little bit sceptical about these monthly CPIs for a long time because I tend to think that there's no evidence that the RBA has done a worse job than other central banks just because we don't have a monthly. And I reckon they're always going to be inclined to say, well, the monthly is quite volatile. Even when it settles down, they'll say the monthly is quite volatile. We've got to wait for a run of 3 months. And so we might as well look at the quarterly and might as well have stuck with the quarterly rather than have this monthly, which I just think creates a lot of noise. Economists love it because they can have more stuff to talk about, but I don't need more stuff to talk about. I've got enough to look at.
Sure.
Traders obviously love it, more stuff to trade on. But by the same token, I think we would be better off without it. That said, we are where we are. The data is up. That is a concern. The money market's gone from possibility of rate cuts next year to now the possibility of rate hikes. And in fact, I think it's got 0 on December. No surprises there. December was always not going to be a rate cut month anyway. But if you get out to the middle of next year, it starts to turn towards a rate hike probability from the money market. I think it's got 47% chance when I last looked of a hike by December.
And Shane, is that a risk as far as you're concerned?
I think it's a risk, but to get that would be kind of odd. We've just commenced an upswing in the economy. To now having to raise interest rates so quickly would be a bit of a surprise compared to what normally happens. It normally takes a while for inflation to become a problem again, putting aside the issues with the monthly. And also when you look at that CPI, a lot of the upswing has been due to administered or indexed prices, which are affected by government decisions or regulators. If you look at private market prices, they're only up 2.8%. So again, you sort of argue here that if you start raising interest rates because of inflation, but inflation is mainly due to government decisions, then you're really going to be crunching the private sector of the economy, which won't be a good thing. And it leaves us in this same situation we've had for years now, where private spending, private investment ends up getting crunched and to make way for public spending. And ultimately, it all leads to less productivity and a worse overall situation for living standards and overall growth in the economy. So I'd be a bit wary about expectations for a rate hike next year. I think 2027 may be, but next year would be a bit premature. And if it does occur, I think it would snuff out the recovery.
Well, Shane, you mentioned earlier about that differential between US and Australian interest rates. Bearing in mind the US cash rate, they're still above where we are here locally. But if that was to close with the US cutting, we're remaining on hold, what's the likely effect on the Aussie dollar, do you think?
Well, it goes up. I think briefly you flashed up the chart there and we weren't talking about it at the time, but there it is there. That chart there shows what happens when you've got a situation where Australian interest rates are rising relative to US interest rates, and that's what will happen here. If the RBA goes on hold, maybe hikes next year, and the RBA and the Fed keeps cutting, then the red line will go up, which is the dashed line at the end of that chart there, from beyond the current reading. And history tells us whenever you have that happening, you can see it through time back to the 90s, whenever the red line goes up significantly, the blue line, which is the Aussie dollar, soon follows. So if that interest differential swings in favour of Australia and continues to do so, then it means a stronger Australian dollar. Historically, that's what's happened. So that's the likelihood here. We'll get more upside pressure on the Aussie dollar. So that would be a concern because you could argue, well, the Aussie dollar goes up, then that puts downwards pressure on inflation ultimately. You could also question whether the Australian outlook is that much better than the US, such that we're on hold potentially raising rates. America's still cutting perhaps 4 times over the next 15 months. Is the growth outlook, is the inflation outlook that different to that in the US? And I'd sort of question that. I think there's more question marks hanging over US economic growth given the tariffs than there is in Australia.
And Shane, of course, this is Black Friday. We're heading towards Cyber Monday. How would you describe the state of the Aussie consumer at the moment? I see from the Retailers Association, they're expecting $6.8 billion is going to be spent over this weekend. That's up about 4% from last year.
How do they know that? I mean, did they survey each of us? How much are you spending? That same story said that you'll be spending $800. Because I think if you participate in the Black Friday sales, I don't know how reliable those numbers are, but I think they translate into something like a 4% growth rate on a year ago, and I suppose you could say that's roughly right because the household spending indicator is running something like 4 or 5% up on a year ago. So therefore, maybe it's in line with that. Maybe that's where they got the numbers from. It's up 4%, so we'll just assume that this weekend will be up 4%, given Black Friday and Cyber Monday. But whatever it is, the Australian consumer, I think, is feeling more confident than they were. There has been an improvement. Interest rates have come down. They got the tax cuts in July last year. So that's provided a bit of an impetus there. But consumers still seem to want to hang out for these sales. We got a boost from the end of financial year sales at the end of June. Then it goes quiet again through the September quarter. Now we're coming into the Black Friday sales, or come into the Black Friday sales. So people sort of go into their caves and don't spend as much. And then suddenly whenever we get these sales events, they all come running out or going online and spending up big. But it just tells you that the Australian consumers are now really addicted to discounts and sales. If you don't get that, things would be a lot weaker.
Indeed, they would. Well, Shane, on that note, happy spending across the weekend.
You too.
Show some restraint. I'm trying to. Thanks. Oh, there's he's gone. Shane, thanks for joining us on AMP. All right, let's catch up with our stock of the day. In fact, it was stocks of the day, as the case may be. And I asked our experts, Adam Dawes from Shaw & Partners and Jun Balu, for their travel-related stock pick.
That's, I think, very well run business. The front of the plane, which is the business class and first class, pays for everything else, and then economy's cream on top. There's so many less people now to get you on a flight than it was 5 years ago. So I think Qantas is really streamlining their business and moving, and is probably one of the best airlines to be run in the world. My pick today in the travel sector is Qantas.
I would agree on the Qantas too, but I think there's a nice little one, which is Webjet, WEB. That's an old WebBeds business. I think the company is on very cheap valuation. It's trading on about 17 times for a double-digit growth. Actually, revenues growing at over 20%. Had a bit of hiccup more recent, a little while ago, but I think they way past these sort of uncertainty and margin stabilize. I think the growth is going to really drive the share price higher.
Thinking about your pre-Christmas shopping? What if you could buy some stonks on sale? Our final virtual event for the year is Cyber Monday. Join expert analysts live as they share their picks of undervalued equities.
We're looking at between 400% and 500% upside.
Because it is going to rally away very, very soon.
Beat the Christmas rush. Register now for Cyber Monday at ausbiz.co/cyber.
All right, let's round out this Friday with a look at the winners and losers in today's trade. HMC Capital is a definite winner there. We were just talking about some of those travel-related stocks, Flight Centre on that list, and the retailers also in focus. Temple & Webster up almost 7% as Black Friday turns into Cyber Monday. On the negative side, though, checking in on that, Eagers Automotive in the retail space. In fact, that's off today. The insurers are in focus as far as the brokers, with some downgrades there, Suncorp among them. COB has also come off. Let's get to what is ahead next week. We get the home value index from Totality on Monday, and Wednesday, September quarter GDP read, and in the US, all important non-farm payroll report, as well as the goods trade balance in the States as well. So, to the market, and well, there you go. We've actually looked as though we're going to finish in the red. We've just turned into the red on the CBO 200. So perhaps that chance of 5 days in a row is going to be dashed after all. Bearing in mind, I am recording this about half an hour from the close of trade. That is the COB. Thanks for watching. Stay with us. The last call is next.